Well, thanks for coming back and joining us. I wanted to take some time today to talk about what I call my risk reward matrix for real estate investors. For those of you that are familiar with Morningstar, this should come as no surprise to you in terms of the form and function of how this works. Morningstar is a company that is dependent upon by many wealth managers that work on the capital market side of the balance sheet. And what it is basically it's a way for someone to take what they own, throw it up on a matrix, and see for and basically see where they stand as far as how risky they are, how much reward they should expect, how much risk they're taking on, so on and so forth. Morningstar. Who is Morningstar? Well, Morningstar is a company that has been around since the early 1990s, and they're the ones that founded what we call the Morningstar Style Matrix. And the idea behind it is that they were going to look at the three different types of stocks way back when, which would be large cap, mid cap, and small cap. In other words, large capitalization, large companies, mid companies, small companies, and then value, blend, and growth. Value companies would be companies that offer a dividend, a yield, a cash on cash return, if you will. Whereas a growth company would be a company that frankly may not have made a dime at this point, but has a lot of potential to just absolutely explode earnings, and as a result, the stock price could go absolutely through the roof. So, using my handy dandy little laser pointer here, I'm going to give you an example of what I'm talking about. If I was to use this chart as a traditional Morningstar style matrix for stocks, this little box right here that I'm outlining here for you, this would be large cap value. In other words, large companies with a value orientation, cash on cash, paying dividends. These represent in the stock market the stocks that are going to be the least risky for the most part. And of course, nothing is guaranteed when it comes to the stock market or the bond market. It's kind of like horseshoes and hand grenades. You can never guarantee exactly what you're going to get. Down here, if we were to look at this, you would see, as I am moving my laser pointer around, you're going to see that this would represent the highest amount of risk and reward that you could possibly have in the stock market. These would be the small cap growth oriented companies. Remember, this would be growth right here. This would be value right here. This would be blend right here. The amount of risk, low risk, all the way to high risk. And then reward would be lots of reward, all the way up to not much reward at all. So a couple other things about this. You'll notice that there are two diagonal lines that I am outlining here for you. These two diagonal lines give us an added element to the style chart. And what it does is it gives us a middle column or a middle channel that shows us what a moderately risky investment looks like. So in this particular example, you'll notice that there is a considerable amount of reward, but a lower amount of risk for notes and liens and for private equity. Why? Well, with a note or a lien, it's going to be guaranteed against something like property, as is private equity. Up here in commercial specialty and manufacturing, you're going to notice that the reward is not very much, but the risk is very high. Why is that? Well, it's because when you're talking about commercial properties, specialty properties and manufacturing properties are extremely hard to find a tenant for. The reason why is because they are built for a specific purpose. Manufacturing plants are usually tooled to manufacture one thing and one thing alone, and it requires a considerable amount of money to retool a manufacturing plant in order to get it to work for somebody else's business. Same with a specialty type of building. If you have a building that is built for a special purpose, it's going to be really hard to rent that to another tenant that is not necessarily in that same specialty. So I can think you can see here how we can look at this and say, well, this is going to be our moderate channel, if you see what I'm saying. So just to reiterate, we've got a lot of reward right here, and as we move up, we're going to get lower reward. And then from a risk standpoint, we're going to have low risk, middle risk, and high risk. Now, real estate is different than stock market investing because with stock market investing, it's pretty much cut and dry. You're either going to have large cap value, large cap growth, mid cap, small cap, international, emerging markets, etc., etc. We know what the asset classes are going to be. But with real estate investing, not only do we have different types of properties, but we also have different strategies for investing. We have different offshoots of real estate investing. We have different methods for profiting in real estate, and there are other alternative investments that actually go alongside with real estate that are complementary to what we're doing right now. So let's take a look at what we would term to be the lowest risk, lowest reward box right here. And first of all would be residential real estate that adheres to government standards. And what do I mean by that? That means, you know, if you've got a house that is ready to go FHA, or it's ready to go USDA, or if it's ready to go VA, there is not much of a chance from an investor's standpoint for you to look at that property, come in, say, you know what, I'm going to give a low ball offer on that property, and hopefully I'm going to get it, and I'm going to get it at a really, really, really low price. The chances of that are not very good. It is not a distressed situation. So if you want something that's going to have those government standards, that FHA, that VA, that USDA standard that is required, you're going to get a very low return on your money. High-end properties inside of a very highly desirable geography. Again, there isn't much room here for growth, gang. I don't think there's much we're going to want to do. And finally, commercial grade A property, especially multi-use property. If you've got grade A commercial multi-use property, you're going to have low risk and low reward. Yes, you're going to have tenants in your property, but you are not going to get the cap rates on your property that you would get from, say, a B or a C grade property. So let's move down here to the most risky box of our matrix, and that would be alternative investments, small apartments, greater than 50 door apartments. Let's talk about that. First of all, greater than 50 door apartments. Why is that so risky? Well, a couple of reasons why. Number one, the vacancy ratio for a greater than 50 door apartment complex is much higher than it would be for a small apartment complex. It's just simply a matter of numbers, of math, if you will. Okay, so from all that being said, when it comes to 50 door apartments, you've got maintenance, you've got utilities, you've got vacancies, you've got the ever-growing chance of having to evict tenants, unfortunately. There are so many things that can go wrong inside of a 50 door apartment that you want to make sure that you are getting compensated appropriately when you make that investment in that 50 plus door apartment complex. You want to make sure that that cap rate is nice and high. You want to make sure that your cash on cash return is nice and high. You want to make sure that each door of that apartment is cash flowing a couple $100s per month. And if it's not, what's the point, for Pete's sake? I can go and I can get a single family residence that is going to cash flow considerably more. Now, granted, I'm going to need a heck of a lot more of those to match a 50-door apartment complex in terms of sheer volume. But from an investment standpoint, my risk by looking at that single family residence with a better cash flow and with a more stable tenant is going to be much lower than a greater than 50-door apartment complex. Alternative investments. What are alternative investments? Well, they could be things like commodities, metals. They could be, they could be anything from like contracts on survivor gear. I'm not kidding. Those are alternative investments that often will make a good, they'll dovetail well into a real estate portfolio. And the reason why is because they do not look like real estate. So when real estate is moving in one direction, there is a very good chance that the alternative investment that you have with your real estate is going to move in another direction. So if your portfolio of real estate is going down or is not in a position, it's down is the wrong word. If your portfolio of real estate right now is in a situation where it's illiquid because the market is no longer supporting the exit strategy that you would like to pursue, having alternative investments would make sense because it might be going up in a direction that is in an opposite direction than where you are right now. Small apartments, we'll talk a bit about small apartments. Why are they riskier? Well, simply because of the same things we talked about with 50-door apartments, but just on a smaller scale. It's not as risky. So let's go to the middle column here. This would be basically the middle of the pack. As is, grade B commercial property and highly leveraged free cash flow. What does that mean? Well, as is. We've all looked at the MLS and we've seen that listing that says property will be sold as is. Well, there's some risk involved in that, obviously. As real estate investors, we know all about risk. And we know that the vast majority of the properties that we're going to buy are going to be as is. Nevertheless, if we go ahead and we make an offer on a property, it's accepted, we buy, we close, we take possession, we put a renter in there, and then all of a sudden we discover that there is a considerable amount of mold that needs to be remediated from a crawl space that we didn't know about. There is a problem there, and it is as is. We did not see it in our inspection for one reason or another, and it is on us. So that makes it a riskier proposition than, say, buying that government standard home that we have up there in the upper left-hand column. Grade B commercial property. These are commercial properties that are going to be hopefully general in nature. In other words, they can be used for a multitude of different purposes. They aren't the top of the line as far as amenities, as far as looks, etc., but they certainly aren't trash by any stretch of the imagination. They just so happen to be regular, everyday, ordinary commercial properties. Good cash flow, decent cap rate. These properties aren't going to attract the strongest tenants, so there is some credit risk that is involved there. But at the same time, it is a solid investment. So we'd go right smack in the middle there as far as being a moderate investment. And then finally, highly leveraged free cash flow. Well, free cash flow is great. We all love free cash flow. But if we are borrowing a substantial amount of money in order to achieve that free cash flow, what that means is that we're waiting, as a lady that I listened to last night talked about, we are waiting until the 28th of the month in order to get paid, in order to make sure that that free cash flow, all the bills are paid, so that free cash flow flows into us. So there is a degree of risk that is taken on when you have free cash flow that is supported by heavy leverage. So those are just a couple of the things that I wanted to go over there with you. There are a whole bunch of other different things that we can do, and frankly, all of these different things that you see on this chart here, or matrix, excuse me, there are different ways of calculating the risk and reward for each and every one of them. And what I do when I visit with a client is I go ahead and I take inventory of everything that they have, and then I use the individualized calculations that I need to use in order to put their assets onto this matrix. And I can show you from a percentage standpoint and then from a standard deviation standpoint how much risk and how much return you should reasonably expect, and of course there are no guarantees, but reasonably expect from having your money invested in this particular fashion. So I hope this has made some sense. If you have any questions, just give me a call. Again, my name's Sean Shaughnessy. The website is www.mdksdevelopment.com. Again, www.mdksdevelopment.com. I can be reached at 816-429-5523. 816-429-5523. Thanks so much. Have a great day. Bye-bye.